Gold prices are trending towards $6,000 as traditional currency protections face a period of increasing pressure. To see how these global shifts are impacting the value of your savings, subscribe for our weekly market deep dives. This chart tracks the price of gold as it breaks through the $5,000 mark. For years, investors viewed that price as an improbable peak, but the data now shows it functioning as a new support level for the market. This shift is driven by three distinct groups: individual citizens seeking an inflation hedge, global policymakers using trade as a weapon, and central banks accumulating record amounts of physical bullion. To understand why this is happening now, we have to look at the specific institutional failures that cause the price line to move vertically. Paper investments like bonds are currently failing to offset the decline in fiat currency. Consequently, gold is serving as the primary functional tool for wealth preservation for both retail investors and sovereign nations. This highlighted spike on the price chart correlates directly with the onset of recent military conflicts and the resulting market uncertainty. After the U.S.-Iran ceasefire collapsed, traffic in the Strait of Hormuz was restricted to 12 ships per day, creating a massive global energy bottleneck. Tensions have also risen within Western alliances. New U.S. tariffs are being used as leverage against European allies in a territorial dispute over Greenland. These events have created a geopolitical premium. This is a persistent risk cost that is now integrated into the price of gold because investors expect further instability. When global powers restrict physical supply chains and trade routes, it creates a persistent upward pressure on the price of tangible commodities. This chart compares a declining U.S. dollar index against the rising gold price, illustrating the inverse relationship between the two assets. As inflation remains above target levels, the purchasing power of cash continues to erode, making non-yielding assets like gold more attractive by comparison. This lack of confidence is compounded by a criminal investigation into the leadership of the Federal Reserve, which has introduced significant policy uncertainty into the United States financial system. When institutional trust in the management of fiat money declines, physical assets with no counterparty risk become the default alternative for protecting capital. Looking at the bottom of the current trend, the $4,300 mark has emerged as a consistent floor for the market. This level is supported by central banks, which are currently purchasing 60 tons of physical gold every month. These nations are diversifying their reserves to reduce their dependence on the U.S. dollar and to protect their wealth from potential economic sanctions. This creates a physical constraint on the market. The supply of physical bullion is being removed from circulation faster than new mining can replace it. When the institutions responsible for managing national currencies choose to hold their own wealth in physical metal, it reflects a structural preference for assets that exist outside of the credit-based system. This diagram combines the cost of geopolitical risk, the decline of the dollar, and the surge in central bank buying to map a projection toward the $6,000 level by late 2026. Based on these compounding factors, institutional analysts now view targets between $6,000 and $7,000 as a probable outcome of current economic trends. We want to hear your perspective on this data. Do you believe the current trajectory is sustainable, or are we looking at a temporary bubble in the gold market? Let us know in the comments. If this analysis provided clarity on these market mechanics, please like the video and subscribe for more reports. The data suggests that institutional trust is moving away from credit-based assets. Gold is no longer functioning as a reactive trade during a crisis. It has become a foundational component of a reorganized global financial landscape.